Investors, hello! This is Stock AI Insights, and I'm your Chief AI Analyst. Just a quick reminder, this is for educational reference only and not investment advice. Investing always involves risk. All right, let's get into it. Global stocks just had their worst week since April, and everyone's trying to figure out why. Today we're parsing a fantastic piece from CNBC that asks the big question, which tail is wagging the market dog? So let's dive in and investigate.
So yeah, that's the central mystery we're tackling today. With so much going on, what's really behind this big market sell-off? You know, the market is a complex beast, and right now, it kind of feels like several different tails are trying to wag the dog all at once. We're going to go on a little investigation to figure out the key culprits behind all this volatility.
First, let's just set the scene. The past week, well, it wasn't just a minor dip. Nope. It was a sudden, sharp shock of volatility that really rattled confidence across global markets. It's left investors feeling a lot more cautious and, frankly, asking what in the world is coming next.
And the data, well, the data tells the story. Look at this chart. As you can see, this was the worst week for global stocks since way back in April, and the volatility was pretty severe. I mean, the NASDAQ saw its wildest swing in months. And this wasn't just a US thing. It was a global phenomenon. Major European indices like the Stoxx 600 and Germany's DAX hit multi-month lows. So there's the evidence. Now let's go find the cause.
Okay, this brings us to our very first suspect, what I'm calling AI anxiety. The artificial intelligence sector has been the absolute star of the market for over a year now, right? But it seems like the heat around these high-flying stocks might finally be starting to burn a few investors.
And what's really fascinating here is that this anxiety is sticking around even when there's good news. I mean, take Nvidia. It posted an absolutely stellar earnings report. Normally, that would send a stock soaring. But this time, the market barely flinched. And that, right there, is a huge tell. It suggests the fear isn't really about one single company anymore, but about a potential bubble across the entire AI sector.
So where's all this anxiety coming from? Well, it's all about something called capital expenditure, or CapEx. This AI arms race is forcing the hyperscalers, the tech giants like Amazon and Microsoft, to spend just astronomical sums on things like data centers. And to pay for all this, a lot of them are taking on some serious debt. This massive spending spree is now making not just stock investors nervous, but bond investors too. They're starting to ask, will the returns actually justify these incredible costs?
And you know what happens when investors get nervous about one high-risk area? That fear often spills over. And that leads us right to our second suspect, crypto contagion. It's really a classic case of risk from one speculative corner of the market infecting another. Jeff Curry, who's the Chief Strategy Officer at Carlyle, he just captures the mood perfectly with this quote. He calls what's happening the revenge of the old economy. He sees a really clear, direct link between the jitters in those high-flying tech stocks and the sharp, sudden sell-offs we're seeing in crypto.
So how does that connection actually work? Well, it's a pretty vicious feedback loop. The theory goes like this. When big tech stocks start to fall, investors who own both types of assets start selling their crypto to cover their tech losses. But that selling pressure pushes crypto prices down, which creates even more panic, forces more selling, and it just creates this violent cycle to the downside that hammers both markets at the same time.
Now, all this interconnected anxiety between AI and crypto is getting amplified by uncertainty from the one institution that can either calm markets down or completely spook them, the Federal Reserve. This is our third suspect, and believe me, it's a big one. The market is really struggling to get a clear read on what the central bank is going to do next.
This slide shows a really critical shift in what everyone was expecting. For weeks, the market was basically banking on the Fed cutting interest rates in December. Well, that hope is pretty much evaporating now. The general consensus view has pushed any potential rate cut way into next year, maybe even in 2026. This long delay in expected relief is forcing investors to be a lot more cautious.
So why the sudden change of heart? Well, there are a few key reasons. First, a recent government shutdown has delayed some key economic data, which means the Fed is kind of flying with limited visibility. Second, the latest minutes from their meetings suggest a pretty clear preference to just skip any rate moves in December. And finally, the overall sentiment out there has become way more hawkish, which is just a fancy way of saying analysts think the Fed is going to stay tough on inflation for longer. And that hawkish stance from the Fed, well, it leads us right to our final suspect, fiscal jitters. When central banks keep the cost of borrowing high, it puts immense pressure on government budgets.
And believe me, those national problems can have global ripple effects.
And this isn't some abstract theory. Just look at the UK. The government there is facing an estimated £30 billion fiscal hole. That's a massive gap between what they spend and what they bring in. And closing a gap that big means really tough choices, like raising taxes or cutting services. And those things almost always create headwinds for the market.
And here's where it gets really interesting from a political angle. The original article suggests that all this global market chaos might actually be giving the UK government some political air cover. You see, it's a lot easier to announce tough, unpopular budget measures when you can point to global instability and say, hey, it's not our fault. This means the politicians might be more focused on pushing their agenda through than on trying to calm the markets.
Okay, so we've examined all the evidence, we've identified our 4 main suspects. It's time to deliver the final verdict. Which tail is truly wagging this market dog?
So our investigation leads us to this conclusion. There is no single culprit here. It's not that simple. As this chart shows, all 4 of our suspects are working together. The AI anxiety spills into crypto. That speculative froth is super sensitive to what the Fed does. And all of this is happening against a backdrop of serious fiscal strain in major economies like the UK. It's not one tail, it's 4, and they're all wagging the dog at once.
So our market pulse verdict is pretty clear. With so many powerful and interconnected factors all pulling at the market, this volatility is likely here to stay for a while. I'm curious, what do you think is the biggest driver? Let us know your thoughts in the comments. We'll see you in the next episode.